Welcome back. The market's at the day's highest level right now, and things are looking pretty strong. 40 points, 84 is where you got the Nifty at, and this is looking, pretty strong. The week has been strong. Last week has been strong. The week before that has been strong. All in all, 500 points the Nifty has added from the lows of about 79.40, 79.50 or so. And it's all been, the market should say a big thank you to domestic institutional investors, mutual funds and insurance companies. Mutual funds rather than insurance companies. Insurance companies, at least the last month, have been small buyers. Most of the heavy lifting is mutual funds. So let's get a perspective in from Sundaram. The Chief Executive Officer is joining us. Sunil Subramaniam with Sundaram Mutual Fund is with us. Mr. Subramaniam, thank you very much for your time. Great to have you as always. First up, congratulations, sir, on the promotion. And I think it's a great time to be heading Sundaram with the market looking buoyant and just terrific.
Yeah, it's not just a market buoyancy. I think we're at the the beginning of cusp of another boom in terms of the Indian economy, and over the next 5 to 10 years, it should be the golden age for the Indian economy. If you see all the indicators that are coming in, there's a lot of noise level which is coming from the outside of India. But if you look at the core Indian story, right, there are lots of positive things happening. Just that the market have been anticipating a bit too much, and that's why there have been these corrections based on news flows. But otherwise, at the ground level, the undercurrent of the Indian economy, I think, is looking very, very strong, and this augurs well for the equity markets and for mutual fund investors.
Look at that number on our screens right now. I don't know if you've got a television screen, but it kind of shows you flows, FIIs, what they've done, and mutual funds, what they've done. FIIs, 6,000 crore sellers since the 1st of June. Local investors have bought about 12,000 odd crores worth of stock. If you break the local number up, it's I think 10,000 is mutual funds, about 2,000 odd crores is insurance companies. The total is the domestic institutional investors, what we call DIIs. Mr. Subramaniam, can you go back in time, go back in history, and tell us a period when, for a significant period of time, FIIs were sellers, domestic investors were buying, and the market was doing very well? Is there a episode with a meaningful episode in the last 20 years?
Second half of 2007.
Okay.
I think the Sensex, if I recollect, went up from about 14,000 to 21,000, right? And domestic flows into mutual funds driven by a huge amount of new fund offerings were, I think, of the order of 60 to 70,000 crores, right?
But that was, that didn't turn out to be all that well a call then, right? That was a time when maybe one should have been pairing positions or whatever. But mutual funds, there was a frenzy, right? Money was coming in, pouring in. So
your question wasn't about whether it was the right time to have money. Your question was, when did the money come in? See, money doesn't always come in at the right time. Money comes in when there's buoyancy, when there is a mood upswing, when there's momentum. And even in the short run, such periods can prove to be a little bit hurting, because if you have got a 1 year, 2 year view, such rapid run-ups, then they didn't take time to get absorbed, and the economy and everything goes through cycles. So I think even if you look at it from a longer-term perspective, right, those people who entered then have also made decent returns if they had stuck it out through the last 6-7 years. I'll just take a case in point of what are considered to be high-risk funds like the mid-caps and the small caps and all of that. We have two funds in that category. You're very well over there. Select, Medcap, Select. So we did an analysis precisely for this, because when distributors and others come to us for advice, is this the right time to put it in? Markets are already running up. So we take this statistic and we did a rolling returns analysis. You know what that is? That is for every day. If you let's say put an investment for varying periods of time, 3 years, 5 years, you would have probably like 2,000, 3,000 periods over a 5 year, a 10-year period. And what we found that if anybody stayed invested for 5 years, right, regardless of whether he entered during a boom or a trough, right, he always made a positive return from, let's say, a fund like ours. So I think the key there, I think though you were mentioning that euphoric time was probably not very good in the immediate aftermath when the Sensex crashed to 8,000, guys who stuck it through for 5 years still made, and the average returns that over a 5-year period these funds are given is in excess of 20%, which well beats your inflation, bank deposits, post office savings schemes and the lot. So I think that your question was right, that when do domestic investors come in? Generally they come in after the news flow and everybody's got a positive interest. So in the short run, there are chances that, they've come in the euphoric period and there could be correction. But all they need is patience. All they need is to just take that and just shut it in their cupboard and forget about it. If they stick for 7 years, even a very passive index like the Nifty, right? When we did a study, a similar rolling return study, nobody who stayed for 8 years ever lost money, regardless of whether they came in the peakest of the peak or the bottom of the bottom. So I think the trick there, I think is just stick it out for the long term. Timings of the market are irrelevant if you're in the long term. And so people will put in money only when they feel buoyant about it. And that may not be the right time, because a year ago, everybody was so despondent and pessimistic, right? But if only smart investors who put their money in, they've seen their money more than double or triple in the last, say, 15 to 18 months. So I think smart money will move in ahead of the curve. Mass retail money will move in only when the mood is right. But whichever way you look at it, if you stick it out for a longer period, I think mutual fund investments are definitely going to benefit a retail or HNI investor.
Right. And of course, when you compared the second half of 2007 and, you're no way suggesting that the fall of 2008 is what we're going to get in 2016, right? Obviously, you're not suggesting that.
I'm not suggesting that, but maybe this may happen in 2022 or 2023, I'm not saying this fall will never happen. The point is, you look at it this way, Rajan, that is 2003 to 7 was when the Indian economy was doing very well, right? So the Sensex went up from 3K to what, 21K in that period. So this was when the time, and after that the economy corrected. Now today the situation is not at all like that. Today the situation is that the economy is on the verge of a boom. So the two situations from an economic perspective are dramatically different. It's just that this period of run-up is looking similar to that period of run-up. But this time, I think the big difference is that time it was a momentum-driven flow, right? There was just money flowing in. There were metals and commodities which were booming at that time. Everybody was just pouring money in. This time, I think if you look at it, there is positivity. There is a lot of confidence. Even RBI governor has come out today and saying that economic level green shoots are happening. The government is doing the right things. And, so stuff like that. So I think that's the key. The underlying economic thread is much, much stronger right now than it was in 2007.
Yeah, no, absolutely. Fair enough. I mean, and there's absolutely, it's a matter of waiting game in that sense, right? Not just for returns, but also for the revival of the economy, right? I mean, it's not as if the market is waiting for that recovery. The market is not doing very well.
Yeah. The market is doing very well. See, what I said was, as I said, Nifty, 8 years you waited and never lost money. But if you take, actively managed funds, even in 5 years you never lost money. So the point is that, yes, if you just play a waiting game, in the long run you never lose money. But you can reduce what that long run is by going for active management through mutual funds, because they not only give you the benefit of diversification, they also give you the benefit of professional research and stock selection. So it's not simply waiting, it's about choosing the right long-term funds to put the money in and then waiting. So, you can always make much better return through an actively managed fund over the long run than you can do it from a passively managed, just wait approach.
Although in the US, I mean, there has been a fair bit of sort of literature and study about actively managed funds and as against an index fund, and studies have shown over long periods of time actively managed funds barely offer the delta on top of returns which passive funds make through. I mean, it's not too much. It's not that meaningful. I guess the situation here is different.
Correct. Yeah. I'll tell you why it's different here. It's because of information asymmetry. In the US, the kind of quantitative that every economic sector gives to the government, the kind of quantitative data every company, whether it's small, big or large, has to give to the markets, and the kind of research effort that goes into even the smaller stocks there, means that over a period of time, this alpha, the creation of alpha is in the early mover advantage, and everybody goes in quickly, and hence, they dissolve away the alpha. But in a matter like India, where information is far from perfect, and it needs close, and the smaller and mid-cap stories, you need to go get close to the owners, study them, understand their business model, know what it takes. And if you take, for example, our company, we research 260 stocks. Now there are 50 stocks in the Nifty. Maybe foreign investors, the biggies, like Morgan Stanley, CSFB, or may cover top 100 stocks in the country. So similar to that, those stocks, if you see, what you say will be true over a longer period of time. That is where there is public information easily available. The ability of fund managers to create alpha consistently does get impaired because information quickly gets dissipated. Everybody gets in on the ball. But in a small and mid-cap space, right, there's huge amounts because people get so sentimental that when something's going slightly wrong, these stocks get hammered. But if you're a smart stock picker and you that in the long run this company has got a good, it's not being valued right, you pick it and you hold it and you can make huge alpha. That's why Indian markets, where there's huge information asymmetry, and companies like ours, which have a huge research base. We have over 19 investment professionals across fixed income and equity who study stocks, about 260 stocks, and then a large number of debt issuances are also studied from our company. And when we then buy, like to give you a statistic, you take our flagship funds like Midcap or Smile, the top 10 stocks that there, we have held for an average 4.5 years, right? So what I'm saying is that if you take purely based on valuation, you come in and after you've invested, it corrects, and some foreign institutions could sell on it, you'll go and sell it. But we don't do that. We stick it out because our basis for that stock selection is a study. Right? The growth prospects, what is the valuation, and both at reasonable valuations is what we always see. And then you buy and then hold. So how does that come? Because when you buy and hold, the long-term prospects of the company's cash flow generation over yes, in times when the economic cycle is going down, that
Mr. Subramaniam, I know we're losing the link there. Apologies to interrupt, but we're losing the link. We'd like to get that answer. So why don't we take a quick break? We'll fix that link, come back to you. And I'll request you to finish that answer, sir. Just take a break. We're back. Welcome back. You with us here on Opening Fire. You've got the market absolutely okay. 0.6% on both the Sensex and the Nifty. Mr. Sunil Subramaniam from Sundaram Mutual Fund has been with us, and he's been running us through what his perspective on investing via equity mutual funds is. We lost you there, Mr. Subramaniam. You were making that point. Could you just quickly complete that, and I'd like to pose another one.
Yeah, I'll just rephrase your question so that we are on board. That is, basically in the US, what you've been saying is that over the long term, the ability of fund managers to create an alpha over diversified funds or index funds over the market is not very great. So, that's the trend there. So you're saying how is it that in India, do you think that such a thing is possible for active management to actually deliver an alpha over the market, right? And where I was coming from was the information asymmetry piece. That is, in markets like the US, this information is so widely available, and so that any special or profit creating opportunity by a new order for a company or improved financials quickly get disseminated among the players, and then so people quickly move into those stocks and the additional profit is wiped away. Whereas in India, because you have a huge base of small and mid-cap companies which are not very well studied, the amount of research which overall as a country it's going into this is very limited, and the few mutual funds which are focused on research and driving that, one of which is ours, are able to generate alpha over a longer period purely because in the mid and small cap space there are lots of companies which have a very good long-term outlook. Yes, when the economic cycles go down, they too tend to get hurt, but they have a sound business model and they have the strength. Some of these companies do have the strength to ride the wave of negative cyclicality, hang in there, and then when it positively comes up, their performance sharply improves. But the trick is that you can't always keep timing the market. You can't keep selling when the brokers and everybody say sell and then go and buy it when they come to buy, because it's probably a bit too late. So if you do your own research, hang in there and wait with these companies through their cyclical phases, you are generally able to deliver much better alpha than the broader market. And I was taking Sundaram Mutual's case in point because we have, like I said, almost about 15 to 18 professionals who are studying the markets, fund managers, come analysts, and 250-60 stocks are individually covered by us, not relying on the outside researchers. And when we go and identify a company, and I was telling you that in our select mid-cap fund, for example, our top 10 holdings, our average holding period of the stock is 4.5 years. So the point is that, yes, these stocks, because of the economic down cycle, would have seen, we didn't lose faith in them and go away from them, but we hang in there. Yes, fund performance will take a dip in the short term when the markets and the Indian economy is down. But when it rebounds, because we are already an existing investor in that, we are able to enjoy the full value upside when the markets start treating their new financials, the new recovery path into the valuations. So I think research-based buy and hold, yes, diversifying across a range of sectors within that period is something that in developing economies like India, which are in a growth phase, can absolutely over the medium term deliver alpha over a index fund or the broader benchmarks indices. So that was the point I was trying to say, to counter what is happening in the US. Yes, as India becomes a developed nation, maybe 15, 20 years down the road, we will also be in a situation where fund managers will find it harder and harder to find those alpha generating stocks, because information again will get quickly disseminated. But right now we are far away from that, and there's a lot of opportunity for a good research based mutual fund which has a diversified kind of approach to the sectors and a bottom up approach to stock booking to deliver alpha. So I think, and then the track record shows that anybody who stayed for 5 years, for example, in a mid-cap fund, regardless of when they entered, enjoyed an average return of excess of 20%, and then they never lost money in that 5-year period. So I think the proof of the pudding is in the eating, and Indian mutual fund managers, including our company, have delivered that additional alpha over the benchmarks.
Okay, fair enough. Mr. Subramaniam, thank you very much, sir. Appreciate you joining in with that perspective. Great speaking with you as always. And congratulations once again. Thank you indeed. Let's take a quick break here. We'll come back in 2 minutes. We've got Mr. Mahesh Vyas from CMIE joining us when we return. That conversation in just 2 minutes.